Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is part 17 of a series of articles I'm doing where I'm covering the various sectors as covered by FactSet. This particular sector is the technology services sector, and of all the sectors I covered, I had probably as much trouble finding really good quality at good value in this sector as any sector I looked at. However, I did find a few. The 5 companies I'm going to be covering very quickly in this sector are Amdocs, Dxe Technologies, of course the venerable IBM, Leidos Holding, and Orcl. And I want to make a couple of points here about the technology sector because it's really kind of a famous sector, if you will. You all recall the technology bubble that occurred in 2000 where you saw the valuations on tech stocks get crazy. Amdocs is no different. This is an information technology services company. Its multiples got up into the 78, 70, 67 PE, and then we saw as we entered the recession of 2001, we saw this correction. But I do want to be clear, there were 2 things that happened. We entered a recession, we had a couple of down years of earnings, but we had this extremely high valuation that caused this huge precipitous drop in stock prices. However, since that time, the earnings, as represented by the orange line on this graph, of this company have done pretty well. They got a little wonky, if you will, during the Great Recession, which is not unusual, but the company did not go out of business, was not losing money or being unprofitable. They just simply had a down year in fiscal year 2009, which ended in September of 2009. Then they had a nice little recovery in 2010, a flat year, but then they've had really good earnings since. And I want you to notice how the stock price followed and reacted to that. They started paying a dividend in 2012, and that dividend has increased. They started out at 13 cents, and then, of course, they had a huge increase to 52, then 59, and so on and so forth, where you see they've increased their dividend every year. Last year, they paid 97 cents, and they're forecast to pay $1.11 this year. The stock got moderately overvalued during this period of time, 2015, 16, 17. In 2018, we had this big correction. It really culminated in December, which has been an ongoing theme. The stock continues to be undervalued, in my opinion. If I look at forecasting, the company is expected to grow about 6%, but if you get this back to a normal multiple, and here I'm going to use a normal PE of 16, there are some really nice rates of return, double digits, 17 to 20% rates of return that I believe you could make over the next couple of years. The company has a really good analyst scorecard. The analysts have been correct about 80 to 90% of the time in a 1-year and 2-year forecast. They've beat the estimates 10% of the time in the 1 year, and they missed estimates 10% of the time in both the 1 and 2 year, but otherwise a pretty good analyst scorecard. So this company has done real well. If I take this company back to where a period of time where valuations were more reasonable, I have to keep going till I actually get into the Great Recession here. I'll use the time frame just starting in 2009. If I look at performance, you'll see that this stock has outperformed the S&P moderately during this period of time when we went from undervaluation to undervaluation. However, there was a period where it was overvalued. Now, I do have, some other stocks here. I want to make a point. I'm going to take a look at Dxe Communication. This is another technology stock that has been somewhat cyclical. It's data processing services. I want you to notice how the price kind of went where the earnings went. The stock had a nice surge in earnings over the last several years. It's forecast to grow at about 11% going forward. If I use normal PEs of around 15, there are some very, very nice rates of return, assuming that this stock recovers on that basis. The next stock I'm going to cover is IBM. IBM has been much maligned for the last several years. The company is kind of going through a transition. As a result, they had a couple of down years of earnings, but I do want you to notice that the stock price has gotten extremely cheap here in recent years. If I shorten this time frame, we have a period where there's been no growth except in the dividend. We've had nice increase in the dividend. If I look at performance, the dividend has grown by about 18% a year, even during this slow growth period of time here. The company is extremely undervalued, offers a 4.5% dividend yield. and would be attractive, not from a standpoint because it's expected to grow going forward, although that growth may pick up at some point, but simply because it's so undervalued that if it simply reverts to the mean, you could get double-digit rates of return with a 4.5% dividend yield. The next company I'm going to cover is one that you may not be familiar with, at least I wasn't, and this is Leidos Holding Company. It's a very cyclical information technology company. I did want you to notice that. But if you look at the last 4 or 5 years, it looks like the company's got its traction back. So I think the real question would be, you need to figure out what's going on, why the company started to grow again. Forecast growth is double-digit, 10% growth going forward on the long-term growth rate. Over the next couple of years, it's more close to 8% or so. It offers almost a 2% dividend yield. And again, decent rates of return going forward, double-digit out the longer you look at it. So here's another one that's kind of interesting. And then last but not least is another bellwether technology software company, Orcl. Oracle's gotten maybe a little bit fully valued, I'd call it. I wouldn't call it undervalued like I think some of these others have been. But you can see it very similar to what we saw with Amdocs. The company was extremely overvalued during the technology bubble. It reverted back to the mean. Otherwise, price has tracked earnings pretty well. The stock is moderately overvalued. It's fully valued to moderately overvalued today. So this might be one that you want to look at on a pullback. But there's one thing I wanted to do with this section, which is a little different. In the article, I talked about companies, in this sector that were actually mostly overvalued. So what I thought I'd do with this video is take a look at not fairly valued stocks in the sector, but a couple of the ones that I mentioned in the article, such as Autodesk. I want you to notice they've had this huge surge in earnings here. They went from a loss in 2018 to $1 in 2019, which they actually have a January fiscal year. And then they're expected to have really good growth going forward. And you can see the stock has been on a tear here. But what's happening is, the company's expected to grow at a very high rate, but the current blended PE ratio is over 123 to be precise. So this is simply a case of would have been a great investment had you been fortunate enough to buy it, although fundamentals wouldn't have suggested that. And we've had this great run up, but now the stock is significantly overpriced. Another bellwether technology stock that people like to talk about that I mentioned in the article would be Microsoft. Microsoft is really an interesting story to me because I wrote an article on this one simply showing, I wrote 2 articles, actually more than that, but I talked about how cheap it was when it was trading at a 10 PE, and this is back at a time when Steve Ballmer was the CEO. And then, of course, the company began growing, a little bit, and the price began recovering, and now all of a sudden this stock is, invincible to many investors, and they're just simply not willing to look at the reality that the stock is trading at a very, very high PE ratio. In my opinion, this is a great company. It's not the time to be buying Microsoft. By the way, as a sideline, they recently hit, for at least a short period of time, $1 trillion market cap, but it's clearly an overvalued stock. Another well-known tech stock would be Accenture. And again, we see a case where you see price tracking earnings, and then more recently we've had these real high valuations. Now, valuations have been high since 2014, and I do want to point out you could have made a lot of money here. And I'm not suggesting that when you overpay for a stock you can't make money, at least over the short run, but I am suggesting that you're taking on more risk than you really should be here. And then last but not least, I'd like to take a look at Adobe. Once again, I just want you to see this disconnect from valuation. This is, I mentioned in the article, a hot sector. We have had a nice surge in earnings growth here. And of course, the normal PE on this stock has gotten up into above 30, which is the blue line here, 32. And now the stock is trading at a 39 PE. And forecast growth is very attractive at about 19%, but that doesn't justify this valuation. If this went back to a more normal PE multiple, let's take a look at normal PE multiples. If it grew at 19, now this is an aberrant PE multiple. Even if it got back to its more normal 30 PE ratios, which I've got on the graph here, you will see that the stock is overvalued. It would take several years for you to start making any real money in Adobe. It's not that it's a bad company. I think the company's terrific. I just think the valuation, Mr. Market has this stock valued at well too high of a premium. Anyway, I hope this gave you some additional insights into not only the technology services sector, but also the valuations that you see in some of these companies. This has been Chuck Carnevale saying thanks for watching. Be talking to you again soon.